And continuing with the next lecture, we have stockholders' equity. And in this lecture, what we're going to go over is different corporate structures and how they issue stock and equity. I'm going to explain the procedure for issuing equity stock. And I'm going to go over what treasury stock is, what happens when you buy back your own stock. We're going to go over the preferred stock element of things. And we're going to go over the distribution of dividends, various dividend distributions. Okay. So there are three forms of business that are primary, right? There's proprietorship, partnership, corporation. In my career, I dealt a lot with partnerships. In business in general, it's mostly they deal with corporations. So we're going to look more on the corporate level with share counts, as opposed to partnership is more like partnership interest, is more like homogeneous interest. Rather, corporation, everything is in shares. Now, a little bit on the structures. There's a corporate organization always regarding these corporations. They have articles of incorporations, and there you have your number of shares and who holds them. So this is what we're going to look at a little bit. And then there's capital stock or share system, where you share proportionate profits to what you own. That's what it was like always in partnerships. For me, I always worked with hedge funds, always on partnerships, and we always had investors sharing the profit according to how much partnership interest they had. So depending on how much you owe, it also depends on how much you lose or gain in the profits, and also upon the ending of the company operations, right? And the preferred stock, we're getting into more, is a little bit more like a bond, because it gets a coupon like a bond, and also is a little bit less risky. There's more safety than equity, but more risk than a bond. So we're going to look more on the corporate structure level on how capital comes in to a business. So from an overall perspective, a capital can only come in a couple of ways. So there's could be a capital contribution, right? So you can have a capital contribution that can go into common stock, preferred stock, and then you could have retained earnings, which comes from your income. Okay, so that's the idea on the balance sheet level. So just to show you more in a more real way of what's going on, is that I'm going to continue with my example of the company that I made in last lecture here. So for our business purpose, so say my company here, the Living on the Edge company, and we have cash of 300,000, accounts receivable 50, total assets is 350, liabilities, I have a bond of 50,000, so my equity is 300,000. Always keep in mind that the real idea behind this is that equity is it's your assets minus liabilities. And the way you get equity into the company is by a cash contribution. Cash comes in and you have equity. It's a funding procedure. So when we're talking about a capital contribution, it just means we have now a more asset, more cash, and we have equity, which is just ownership. We have more owners, right? So when we issue stock, there's a technicality around it. There's par value, non-par value, stock issued with other securities, cost of issuing stock. But what's issuing stock? In reality, when you issue stock, all that really means, say for example, we used to have on our balance sheet, we used to have 100,000 in cash, and we used to have 50,000 of AR, assets of 150,000, a bond of 50,000. And then that was at 12/31/2012. January 15, 2013, we issued some equity. So what does that mean? We have now $200,000 more cash, and we have $200,000 more equity. So it's literally just a cash contribution. Somebody, it's like I own say I own my surfboard company. I put in 200,000 in. That's really what happened.